Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, good morning, Jim, and good to be with you.
How are commodities looking right now?
Well, we were looking for a rally in most commodities from last November out until around March, where this is around March. And a number of them sort of made it till February and then took a correction. And but hey, it was just sort of a target out there. And now there's a few that are firming up, cotton and sugar and things like that, and kind of like another go. So, but and crude oil, they're trying to keep it the game going, but it looks like commitment of trader figures are building such that one would conclude that whatever strength in commodities around would soon fail. And this, of course, then on the other side of the teeter-totter would be long government bonds, which have been in a bear market since July, and that's the Treasuries, and bottomed a month and a half ago, and tested the bottom, double bottom, and they've moved up. So it could be an interesting trade. Commodities down, long Treasuries up. Now also, trading with commodities has been the high yield and junk bonds, and they were really strong here until a few weeks ago, and got some actually a few weeks ago, I mean that was the end of February, got some very strong momentum readings on that one and on the HYG, and so the high yield stuff, low grade stuff could go down, and on the other side of the trade you would have long dated Treasuries and Government of Canada's going up. It looks like it'd be a good trade.
The federal government announced it was phasing out Canada's savings bonds. Is that going to impact consumers at all?
No, I don't think so. They were down to who knows what the yield on them was, but back in the day of high yields, they were good, both sides of the equation, government offering the bonds and investors buying them. It was good for both sides, and now they're gone, and I have no great regrets about that.
Gosh, I remember, I think back in 1980, they paid 21%.
Yeah, that was the height of interest rates. 1981, you had inflation up to 15 or 16%, and the long-dated Canadas got up to 19%, and in the States, the long-dated Treasuries got up, I think it was about 15%. Remarkable, there's been no other time when the interest rates in the senior currency got that high. Prior to that, of course, it was London was the financial center and sterling was the senior currency, and the highest ever was around 6% in 1797 when England was in a panic about a potential invasion by Napoleon. So that interest rates got up to 15% in the senior economy then is just staggering, particularly when you realize that the whole attempt beginning in the late 1940s and running right through, the policy intent was to lower interest rates because the government had taken on in the States so much debt with the war, and it was all 2.5% to 3%, and it became simple mathematics to note that if it got above 3%, the cost of servicing the debt would go up. So then the Treasury started buying bonds out of the market, and they bought bonds, and they bought bonds. So then in the 60s, when interest rates were up to 6%, they did a big display, and they called it Operation Twist, where they were really going to buy bonds, and that was to keep them from rising above 6%. So what it was doing was injecting so much money into the system and the market then decided to bid up commodities and wages, so you had high CPI inflation, and of course you had that premium put into the yield structure, and you then ended up with Treasuries at 15% instead of 6%, mainly because they were trying to lower interest rates. I mean, policymakers get very weird at times. And, of course, we all know when they decided they were going to drive gold down, and the Bank of England was the last to sell gold at $254, and then it takes off and eventually ends up at $1,900. So when you see policymakers really dedicated, you know that eventually the plan will go wrong.
We'll have more with Bob Hoye right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're talking with Bob Hoye. Bob, there's presidential approval for the Keystone XL Pipeline. Good news for Canada?
Yeah, well, also good news for common sense. It is worth recalling that at various times that pipeline expansion was approved by State Department, by environmental departments, and by everything. And then the final go on it, it was just down plain simply in Obama's hands and he just didn't want it. Of course, he was currying favor with a whole bunch of radical environmentalists. You know, the irony is that during Obama's 8-year term, there were some 10,000 miles of pipeline built elsewhere. And this is about, I think, 1,100 miles of pipeline. So, it was the intransigence of one single individual thinking he was representing an important block of people, and on a personal whim, and this is dangerous, a personal whim, it wasn't going ahead. So Obama gone, you can get back to due process, and the pipeline will go ahead eventually. So, and the irony is that the Gulf states, of course, is where the main and a huge amount of refining capacity is, and it built up largely needing heavier crude oils, and this, of course, is what Alberta is producing. So it's good all around, and also it shows that government can at times be practical.
OPEC is now talking about extending their production freeze. They're kind of disappointed prices have gone into the upper 40s. But at the same time, would it even be there if they hadn't have frozen production?
Oh, right. I mean, this OPEC is really an example of bureaucracies doing the wrong things. They quite simple-mindedly decide, oh, well, the price is too high. If we all agree to cut back, then the price will be higher. But then each is selling less. So they're not making as much money anyway, so who knows what the exact numbers are. But the problem is that when beginning 2015 it really started to fail when crude was about $100. And then it came out that Saudi or the Arabians were selling crude hard in order to destroy the new fracking production in the States. And that was something invented by journalists, I'm sure, because the decline in crude oil to a new price regime was predictable. I mean, it had already happened for natural gas, because the natural gas market, mainly continental North America, and it cracked a long time ago. So then the other ones, and we wrote this up at the time, was that you go back in history, in the early 1900s is when the copper miners discovered how to mine low-grade deposits. And the example was Bingham Canyon, just south of Salt Lake City, Utah. And they started mining that for copper in 1910. Now, in the late 60s, they used to go down to ski at Alta, Utah, which is just near Salt Lake City, and took a day off and went over and viewed Bingham Canyon. And it was the biggest hole in the ground I'd ever seen. Then it had rails and trains to haul the ore up from the pit. And believe it or not, many years later, 50 years later, Bingham Canyon is still operating. And then in the 70s, you had the mining of gold shifted over to where they could mine low-grade gold. So it took a long time before the revolution in mining gold came along. And then now what you have is a similar technological revolution for getting oil. And this fracking is absolutely fantastic. It's like, what's going to happen is that, or it's already happening, is that these guys, the moment the price goes up a little, bang, they can just turn on the taps, so to speak. And you've got areas now, even in Argentina, a state-run oil company can now produce crude from fracking at $40. And then there are places in the States, in these fields, where they're down, some of them, their costs are down to $15. So it's a remarkable revolution. And the idea that Saudi is going to lower the price of crude to knock the Americans out of the market is very naive. And you can see crude going down to very low prices. We had a target that in gold terms, crude oil can fall to 1/3 or 1/4 of the high. Well, that works out to, in dollars, around $27 a barrel. Didn't think it would get there so fast. It got there last year in January, February. But let's crank in that possibility of something like, say, $30 crude oil on annual averages, and then you'll see what happens there. So this should pretty well devastate OPEC and the idea of managed supply. It's not going to work. It is going to be a fabulous embarrassment indeed. So I'm looking forward to it. It'd be lots of fun.
We'll have more with Bob Hoye right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Bob Hoye. Bob, what's the outlook for long-term Canadian treasuries?
long-term Canada's. Let's put it in the big picture. We use the U.S. Treasuries because it is the big market. Last year, when on a tremendous rally, it rallied up and generated all kinds of technical excesses, and we concluded that was early July, and we concluded that was ending action, the top of the market, the biggest top in the bull market that started in 1981, and that a major bear market would follow. This would not be, as many people think, or many analysts are hoping for inflation to come along and get serious, but I think not. It would be due to the inability of both corporates, provinces and states and federal governments to service debt. And in a post-bubble contraction, you can have what we've called a great bond revulsion, where people all of a sudden say, "Oh, I don't want to have anything to do with these things," especially because you got falling prices. So you have, in the bond markets, you have two kinds of risk. One is are the interest payments going to be made, and will they redeem the bonds when as they mature? So that is risk, credit risk. And then the other risk is price change, where you can have the highest grade securities like U.S. Treasuries or Government of Canada bonds, and you're out 20 years, and then you can have changes in interest rates, so the price of that bond will go all over the place, and it's too high now, but bond prices going down then is term risk. So, there's always risk in the bond markets. Now, it's likely that we could have a brief rally in the long-dated government bonds, because they got hit so badly into January. And there's a possibility of weakening commodities, which would help a bond rally. So maybe a few months of a bond rally. But from the problem would then come from the corporate side and from more risky credit in the government side, that you could then have the adjustment for credit risk, where the price goes down and yields go up. And that may get bad enough that it could affect extremely high-grade stuff like Government of Canada's and Treasuries. So we look at it as a trading market for a few months on Government of Canada's, but after that you get back into a risk market, because you could have a major rise in interest rates, not due to a return of CPI inflation, but due to growing inability to service debt. It'll be interesting.
Bob, thank you so much for holding in there with that bad cold.
Hey, we made it through, and I've got my fingers crossed, and thanks very much, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. By the way, if you have any questions for Bob, you can email us at info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.